Well, good morning or good afternoon, everybody, and welcome to the Saginaw County Chamber of Commerce Big Strategies for Small Business. My name is Nancy Stevenson, and I'm the Director of Communications and Events for the Saginaw Chamber. And though I spend most of my time behind the scenes, I'm very happy to be able to facilitate today's Zoom. We have just a couple logistical items for you to be aware of. During the Zoom presentation today, you will all be muted. However, you will have an opportunity to ask questions at the end of the presentation by typing them into your chat. We'll remind you when we get to that point a little bit later. We also suggest that you set your view to speaker mode to optimize your viewing experience. One of our highest priorities at the Chamber is to support small business success. Excuse me. In fact, the Chamber has a whole series of events, promotion opportunities, and strategies designed specifically to help our small business members. We invite you to explore our website at www.saginawchamber.org or give us a call anytime to learn more about them. For those of you who are here for the first time, Big Strategies for Small Business is a series of 3 lunchtime meetings featuring topics to increase business traffic, improve customer service, and enhance management practices. As a small business looking to attract and retain employees, attract qualified clients and customers, and grow your business success and bottom line, you look for resources that will give you a competitive advantage and allow you to provide financial stability for you and your workforce. The Saginaw County Chamber is dedicated to providing and connecting you with those resources, as well as helping our members find business solutions for some of their toughest challenges. That was the reason we initiated the Big Strategies for Small Business series, and we're really glad that you could join us today to check us out. But before we go into our main presentation, I do want to acknowledge the contributions of our amazing sponsors who make the series possible. Let me get to my correct screen here. Our thanks goes out to the small business sponsor, Blue Cross Blue Shield and Blue Care Network of Michigan, and they have provided a short video for you today, which I will show you right now.
For 81 years, we've been here for Michigan, from day 1 to year 100, committed to the communities we call home, because we're here for it all and always will be. Confidence comes with every card. We're here for you, with resources that make connecting with your coverage and getting the care you need easier than ever before. We're here for it all and always will be. Confidence comes with every card.
Thank you, Blue Cross Blue Shield. I'd also like to acknowledge today's speaker sponsor, Covenant Occupational Health Services. Covenant Occupational Health is a proud provider and resource to 7,000 plus companies throughout the state of Michigan, offering pre-employment testing, wellness programs, industry-specific medical surveillance and training, workman's comp injury care, and most recently, COVID pre-screening and testing. I want to thank both of today's sponsors for supporting today's event. And now it is my pleasure to introduce today's featured presentation. Business owners have experienced significant disruption with their business as usual operations. With these added difficulties, it is easy to get tied up in the day-to-day challenges. Yet business owners who are successful embrace big picture thinking as the driver of their business's recovery, growth, and success. With us today are Peter Bender, CPA and CFP, and Michael Oliphant, CPA and CVA, both from Yo and Yo CPAs and Business Consultants. They are the co-authors of the publication 5 Steps to Drive Business Growth and Recovery to Fuel Your Dreams, which you will all receive via email after today's presentation. For right now, though, please welcome today's presenters, Peter Bender and Michael Oliphant.
There we go. All right, thank you, Lisa, and welcome everyone. We're pleased to be part of the Chamber's 3-part event series, Big Strategies for Small Business. As Lisa said, my name is Pete Bender. I'm with Yo and Yo CPAs and Yo and Yo Wealth Management, and joining me today is my colleague, Mike Oliphant. Also behind the scenes, we have Kim Dahl. She's our marketing director. She helped organize all of this for us, and she'll be advancing the slides today for us. and keeping us all in sync. So thanks to Kim for that. If you're a business owner, you likely spent years building a successful enterprise, and it hasn't been easy, I'm sure. You've had successes, you've had victories, but you've also experienced setbacks, especially in years like we have just experienced. So as you reflect on the past, the present, and especially the future, ask yourself some of these questions. Is your business growing, or are revenues just making ends meet? Are you measuring the right things that affect your business and your future dreams? Do you have a plan to pivot operations or preserve cash flow when necessary? Do you work endless hours and seem like you have nothing left for personal time? Do you have a succession plan for you and your business? And is your business going to provide enough cash flow to provide you with the retirement you desire? In today's presentation, 5 steps to drive business growth and recovery to fuel your dreams, we provide you with insights, ideas, and resources to help you live the life you desire and hopefully help you answer some of the questions we just discussed. There are 5 steps that Mike and I want to touch on today, which include know the value of your business, which is identifying drivers that affect its value, know the numbers, focusing on key performance indicators that enable you to operate your business more effectively and drive significant changes throughout your organization. 3, know your plan. Prepare yourself and your business for uncertainty. Know how to reduce expenses, conserve cash flow, and plans for pivoting. Know your wealth. Understand how your business and your personal life support each other. And finally, know your future. Create a clear vision for your business and you with specific measurable objectives. Before Mike gets started, I want to tell you a little bit about myself. I've been with Yo&Yo for 32 years, providing tax, accounting, and various advisory services for my clients. I'm currently the leader of Yo&Yo Wealth Management, which through our partnership with Advantax Planning Partners provides asset management, financial planning, insurance planning, estate and retirement planning for businesses and their owners and individuals. I've done a lot of tax work throughout the years, preparing individual returns, small business returns, and trust returns. And a lot of my focus over the years has been providing services for agribusiness clients. I served on the board of directors recently, the past 6 years, and I serve our community through sitting on the board at the Franklin Credit Union, as well as Wellspring Lutheran Services. And I'm also active in St. Lawrence Lutheran Church and our church foundation. So with that, I'd like to turn things over to Mike, my co-presenter for today.
Good afternoon. My name is Mike Oliphant. I'm a CPA and a CVA. For those of you who don't know all the acronyms, CVA stands for Certified Valuation Analyst. So I've been with the firm for 28 years. I work in both the accounting and advisory roles. I have an emphasis on construction, manufacturing, retail, wholesale, and some other various areas that I focus on. My other hat that I wear, and I've been doing this for about 12 years, is the valuation area. So I do valuations for many different reasons and purposes. And then I also do some work in our litigation support section. So I've been able to testify in court a couple times, which was fun. Had a Zoom trial here recently, which was really interesting. So starting to get used to Zoom. And then just in terms of other areas I specialize in, again, in that valuation area, I've done work in succession planning and setting up business plans, startups and divorce, among other things. I serve on our, and by the way, I'm in the Kalamazoo office. I serve on the Kalamazoo Valley Habitat for Humanity. I'm a board member and also the treasurer of that organization here in Kalamazoo. So that's my background. So the first area I'd like to get into here is knowing the value of your business. I think this is an important area for all business owners to strive for, to really understand what the value is of their business, not necessarily just the day-to-day operations, but really getting into, what is your business worth? And so in that specific area, there are several different reasons to have a business valuation. And I'm just going to kind of go through a few of these. One area specifically is just in terms of strategic planning, really just kind of having an overall knowledge of your business and understanding, in the long run, what it's worth, and to help you make decisions on a day-to-day basis, but also more longer term. If you have a partner, or let's say you're in a multi-member LLC, a buy-sell agreement is something that is a must. You really need to have a good buy-sell agreement in place, a good contract that outlines each partner's responsibilities, as well as if there are any specific situations that may occur, such as God forbid, a death of a shareholder or some tragedy that might happen or occur. You understand based on that buy-sell agreement exactly what needs to occur, how the business gets transitioned or transferred, if there's a life insurance policy that's set up to pay for the business, and ultimately what that business is worth. So obviously, in order to answer some of those other questions, we need to determine what the value of the business is. Other areas off the top are estate and gift. I've got a client right now that's going through a gifting strategy over the next 10 years, where the mother and father are gifting shares to both the son and daughter to kind of transition the business into their name, and they're getting out of the business. And we on this one, I'll do a valuation about every 2 years to determine the value and help them with that transition. Another area is, you're looking at potentially selling the business to outsiders, or if you're looking at potentially purchasing a business through a merger and acquisition, or simply just looking at a business as a potential purchase. That's another area where a business valuation is something that can help. You don't want to leave any money on the table, and you certainly don't want to overpay for a business. So it's just something that makes a lot of sense. And I have quite a few businesses I've done this for. So let's go to the next slide. So how does a valuation occur? I'll just give you kind of a quick high-level snapshot of what that looks like. Generally, what I'll do is I'll do a comprehensive financial analysis. I'll generally look at up to 5, sometimes a little bit more, but 5 years is a really good period of time to kind of look for trends and look for and observe that time frame to see how the business does or has done historically, and look for trends and various things that will help me to help the business owner make decisions in that area. Once I kind of go through that business analysis or that financial analysis, I'll meet with key individuals of the company, specifically the CEO, the president, upper management, those key decision makers that really help to drive the company. And then also it helps me, that's one of the, I think, more important aspects of doing the work, is to kind of get into the details, understand what drives the business and some of the different trends and so forth with the owners. And then I'll also do an industry analysis. I'll compare that business with peers within the industry. We've got a couple different benchmarking programs that we use internally that helps with that, where we can really drill down to that specific industry and try to identify comparative companies that we can benchmark against. And that's really an area that I think helps business owners understand how they're doing against the competition, and also it's really kind of it just allows them to kind of grade themselves with others and benchmarking that process. So that's another part of the doing the valuation work. Then I'll go through, there's, and next slide I'll tell you in a minute, but there's 3 different valuation approaches that I'll look at, and then finally I'll conclude on a final value. So that's how that's the overall process in a nutshell. And then there's 3 different approaches to valuing a business. There's the asset, market, and income approach. The asset approach generally is looking at the fair market value of the business's assets. Generally speaking, that's what we call the floor value. It's not necessarily a company that's making money, that's earning a profit. Generally, that's not what the approach I'll be looking at. I'll most likely look at either the market or the income approach. The income approach 90% of the time is where the value is for a specific company. The market approach, if I can find comparative comparative analysis to look at through our databases and get to specific transactions, I may look at the market approach as more of a sanity check on my income approach. So generally speaking, the income approach is really where the value of a company is when I'm going through this process. And then once I've gone through the valuation process and we've come up with a final determination of value, a lot of times I'll have business owners say, well, this is great, Mike, but how can I grow the business? What, let's say I value the business and it's $1 million and they thought it was worth $2 million, which a lot of times business owners generally think that their business is worth a lot more than what a third party might say it's worth. And so I may go through some of these other areas with the business owner to say, okay, here are some things you can think about to potentially affect or increase the value of the company. One might be diversifying your product or service offering, spread out to other areas. Obviously, the old adage of, don't put all your eggs in one basket really helps out here, because if you diversify, that's going to minimize your risk. The risk is going to drop down, and the value therefore is going to increase. And so that's one area. Another area might be expanding the customer base. That's going to create some volume, which will obviously impact value. You have to make sure that you have the appropriate staffing and cost structure in place to absorb that volume, but that's another area that might help growth. Hiring key individuals, and that's really tough, I think, in today's environment. I don't know about all the participants on this particular webinar, but I know that in our field, in the accounting profession, it's been very difficult to find good qualified employees. So that's an area that we've been struggling with. And but if you can find the right people, they can certainly help you drive growth. So that's another key area that that can help affect or impact value. Obviously, expanding into different geographical areas, again, diversification of location in that case. And there are several other areas and points that we could bring up that could drive, that can increase the value of a company. But those are just some main points there. So that's really kind of in a nutshell what a valuation is, understanding the value, because that's really the first area that has to be discovered and acknowledged before you can kind of move past that. The next area I want to talk about is knowing your numbers. Again, we love to use initials and acronyms. This one's called KPI. And this is a key performance indicators. Key performance indicators are those, those metrics and ratios that really help you to understand the nuts and bolts of the business. The analogy I like to use is it's kind of like the human body. Without blood, the human body is going to die. with a business, if you don't have cash flow, the business is going to die. So this helps to, looking at some of these key indicators will help you to understand your cash flow and some other areas, or key performance areas within both the balance sheet and the income statement of a financial statement, which will help to help take the pulse of the company. So what do KPIs do for your business? They deliver an immediate snapshot of the overall performance. So it really kind of gives you a day-to-day snapshot of where things are, helps you to focus on the people, and gets everyone within their area of expertise in a common situation or a common goal where everyone can understand the outcome and hopefully strive for success of the company in terms of the long-term goals. It helps to ensure that there's proper management of the company and the resources. Really, it allows you to engage the performance of the company. So they need to be flexible and adaptable. So key performance indicators are ratios that really need to relate to specific measures of the company. So another key aspect of KPIs, or key performance indicators, is they really need to be smart. They need to be specific, measurable, achievable, relevant, and time frame. So they need to encapsulate those key components in order to be a good qualified a KPI that's going to help you to understand your business and to keep you on track. So what are different KPIs? What are different key performance indicators? I believe that you either have or will have a list of these, or actually some specific ratios. I believe I've done 3 or 4 ratios in each one of these different categories. So I'm not going to go into them in real specifics, but overall, the ones you should look at are liquidity ratios, profitability ratios, efficiency ratios, and debt risk ratios. With respect to liquidity ratios, those really deal with the balance sheet, and those are items such as our key performance indicators, such as the current ratio. So the current ratio is your current liabilities, current assets divided by current liabilities, and it really looks at your current liquidity and the ability to pay your current debts. So that's just one in the liquidity ratio. Profitability ratio. EBITDA is another one, that a popular metric, which is earnings before interest, taxes, and depreciation. So that's another area that you might compare yourself with other industry metrics that will help you to identify where you're at with respect to the industry. That's another key ratio. Some of the other ones are related to debt. And all of these ratios, if you have, for instance, if you have bank loans, they have covenants, and you have to keep within those covenants. These ratios will help you to understand where you're at within those bank loan covenants. So those are important from the standpoint of a banking situation and the ability to pay your debt. So those are just a high level overview of the different ratios. Again, I'm leaving you with some more detailed information. Hopefully you'll have at the end of the meeting. So once we get through understanding the value, and once we get through knowing your numbers and being able to identify those various ratios and the things that will help you to monitor the pulse of the company, the next thing is knowing your plan. And this area here really kind of spawned out of what happened over the last 12 to 14 months with the pandemic, and just kind of having to shift resources and really try to understand what we need to do to continue to be in business, with help from the federal and state governments and other granting resources that certainly have helped. But there's certain things that we can do internally as business owners that help to make sure that we stay in business for the next year and hopefully for the foreseeable future. So that's kind of what this next section discusses. Go ahead. So the first thing we want to talk about is managing cash flow. Again, talked a little bit earlier, managing cash flow is really the lifeblood of the business. So you really need to make sure you're paying attention to cash flow. One thing to do is to look at creating a cash flow projector and really analyzing cash flow on a more frequent basis than, say, at the end of the year, at the end of the quarter, really looking at it more strategically. So the first thing, as far as what the slide says, is you want to have a broad frame of mind. What does that mean? What that means is kind of looking at different expenditures that you might have, or you have a plan to purchase a piece of equipment or a vehicle. What's the best way of doing that? Does it make sense to purchase that piece of equipment, or does it make sense to lease the equipment over time? Those are decisions that you can't really answer quickly. You have to kind of go through some analysis to determine whether or not that makes the most sense. Another aspect of that is our tax ramifications. You buy a piece of equipment or a vehicle and you can write it off immediately. You're going to get a better tax benefit, which obviously will increase cash flow in the near term, but it's going to maybe have a detrimental effect longer term. So those are other decisions that come into play. And so it's not a cut and dry answer. It's something that we have to spend time and analyze a little bit. Creating a budget. Budgets are a great vehicle or a great snapshot of where the company's at. And obviously, if you can compare your actual cost to the budget over time, that's going to help you as you look forward and have to make other quick decisions based on where the budget is and where those costs are coming in. So if you're having cost overruns on a project or just in the business in general, you can pivot and you can make changes quickly, as opposed to waiting till the end of the year and looking back and realizing that you just lost a lot of money because you didn't know, you didn't properly plan or budget. So that's another area that is important in terms of managing cash flow. Stay conservative with timing. You know, again, when we're developing a cash flow model, what does it look like from the standpoint of cash receipts, for instance? You have a customer and you're looking at a big payment coming in, and maybe it's $40,000. Is that coming in tomorrow, or is it really coming in next week? You need to kind of have some realistic expectations of when cash is coming in the door. So that's another area that you need to pay attention to. Maximizing cash inflows and shrinking cash outflows. That seems elementary, but you know, there's certain, it takes a little bit of thinking. One area in terms of cash inflows is, well, maybe we set up the customer on some sort of electronic bill pay where it's an automatic payment where it's just coming in automatically. If they're accepting to that, and that gets cash in the door a lot faster than waiting 30 days for a check to arrive, for instance. Or when you're paying out bills, take advantage of discounts and different areas there where it's going to save you money on the front end. So I mean, you have to think a little bit outside the box in terms of what are some of those areas that will help to maximize the cash coming in the door and shrink the cash leaving the door. So, and then building a cash reserve. I think this is pretty important. I have this conversation a lot with clients and customers of ours. Really, if you look at your operating budget over a calendar year basis, it would make some sense to try to set up an operating reserve of, say, 20 to 30% of that of the annual budget, and that's a really good. I think it's a really good proxy for having a buffer there in case you have a situation where there's a cash flow emergency or a pandemic. God forbid there's not going to be another one of those, but a situation that might come up that might cause some concern. You'll have that protection against future shocks. So that's just something to think about. It's tough to do it on the front end, but once you have that built, you can kind of nurture it. it sits there and it's a rainy day fund that will be real helpful. So, and then the other areas really make conscious efforts, or excuse me, conscious decisions when it comes to administrative costs. Is this person really adding value to the bottom line? I mean, that's a tough decision that you have to ask yourself. Or does it make sense to outsource? We have several clients at our firm that we are their outsourced accounting function. It kind of, you think about it, it's like, wow, that's like taking part of our whole business out the door. But if you think about it, you think about some of the other cost savings, employee benefits, workers' comp, health insurance, all of the other things, missed days. We're set up where if we have an employee that gets sick, there's someone else that's there to help out. So there's always someone to help plug in on that outsourced accounting. So that's just another example of kind of thinking outside the box when it comes to managing cash flows. So finally, what that really gets you to then is pivoting. So, we get to a point or a fork in the road, whatever you want to call it, and you have to make some decisions immediately. The most important thing is to communicate. Communicate those decisions to your employees, to your various stakeholders, your customers, be it through social media or through the mail, whatever it is. Make sure there's constant communication so those that you rely on your business understand exactly what you're doing, so that you don't lose business. You still have to run an operation, so that's something that's important, and you need to continue to communicate that. You need to be able to adapt and pivot and to change and to meet new demands and needs. Things change. In-person meetings hopefully are coming back, but over the past, again, 12 to 14 months, we've been doing a lot of Zoom calls and meetings, and it's been working, but it's different. But we've had to make that work for a lot of situations. So, something to think about. Learning a new skill. That's another area where, if you have to expand your business or make a change, it's just something you have to be prepared for. Inform your employees of whatever changes you have to make. Obviously, that goes along with communication, but you don't want to lose valuable employees because you have to make changes, and it can be scary. So, and then obviously monitor your strategy and restock and take a look at everything on a regular basis to make sure that you're doing what you said you were going to do, and keeping ahead of it. So those are the first three areas: knowing your value, the numbers, and then also knowing your plan. Once you have those in place and you have a good foundation, the next area we kind of need to look at is knowing your wealth. And so I'm going to turn it over to Pete Bender, and Pete's going to take it from here and kind of really talk about how the personal investment decisions and business, the business work that you've done kind of interrelate with each other.
All right, thanks, Mike. So far, Mike has talked a lot about different topics that relate strictly to your business. But as he said, we also need to think about the personal side and how your business affects you personally. And that leads to step 4, which is know your wealth. According to a study from the Exit Planning Institute, about 80 to 90% of most business owners' net worth is tied up in their business. So while this is a large percentage, it doesn't always represent the complete picture of your personal wealth. And that's why we need to look at the business and personal together. Knowing that total amount of your wealth is very important as you plan for the future. So the best place to start is to determining this amount of your personal wealth is to come up with a personal inventory, or a lot of times it's called a personal financial statement. So basically, this is just creating a summary of your assets and your liabilities and determining your net worth. Your assets would include such things as savings and cash accounts, investments, retirement plan accounts, both in your current business or maybe in a prior employer. The value of your business interest, Mike talked about that, how we determine that. any real estate that you own, maybe insurances, different type of insurance policies, or any other assets that you might have. Then we also need to look at the liabilities, any debts that you have. This would be mortgages or other personal debts, car loans, things like that. And then of course, business loans. So once we have this inventory created, it's important to make sure that you update that annually. You need to do that so that you can monitor that you're still on track to reach all the goals that you've set up for your future and for your retirement. So in addition to doing the financial side of it, that inventory, there's a few other things you want to make sure you're following up on a regular basis. This includes ensuring your estate and trust documents are updated. General rule of thumb for that is to review those every 5 years and make updates as necessary, or probably more importantly, whenever a life event happens. So if there's a change, a marriage, some kids come along the way, unfortunately, if there's a death in the family, when those things happen, you definitely need to make sure you take a look at your estate and trust documents and make sure they are going to reflect what you want. You also need to make sure on an annual basis you review your current insurance to make sure it's adequate in case of personal or business emergencies or catastrophes. Again, should be done annually or as your situation changes. You also need to review your wealth management program and your retirement plans on a regular basis. This, I would say, at least annually, if not more often. One thing you want to make sure when you're doing this is that you're working with a qualified advisor who's going to take a holistic approach that takes into account your entire financial picture, as well as the tax effects of your financial decisions. By using this holistic approach, you can ensure that your investments outside of the business align with your personal goals, your immediate cash needs, and your retirement plans. As part of doing that, you want to make sure you consider the following when looking at your investments. Are you taking enough risk or maybe too much risk, depending on your current situation? That would involve how much money you have invested, how old you are, or how soon you're going to need these assets. So you want to take a look at that on a regular basis and make sure your asset allocation and investments are adjusted appropriately. You also want to make sure that your investments, including your retirement plans, will provide enough cash flow when needed. You want to make sure they're flexible, that your money isn't tied up in products that don't give you flexibility if you maybe need it for an emergency or when you retire and you need the cash to live on. As a business owner, you're also going to want to make sure that any retirement plans that you sponsor through your business are compliant and up to date with the latest regs and regulations. That gets more complicated all the time. So we are constantly helping our clients with that. And then also making sure that retirement plan is the most effective tool, the right type of plan to get you the most bang for your buck and for your employees when you're putting money into that plan. Finally, you want to make sure you've established a transition and a plan for your business, for the operations, and that accounts for retirement and any other unforeseen sudden exits. Mike touched on this a little bit. And so we want to touch, that's a very important part, being, as Mike said, ready to pivot, being ready for the unseen and unexpected. And so I want to dig into that a little bit deeper. Once you know your wealth and you have a clear picture of where you're at, like I said, you want to make sure you're prepared as you can be for certain things. Up to 50% of businesses say their transition plan is affected by the 5 Ds, which are generally unexpected, that being death, disability, divorce, disagreement, and distress. So let's talk a little bit about each one of those. So when we're dealing with death, as Mike mentioned earlier, buy-sell agreements are key, and making sure we have the right investments and insurance in place to help fund those buy-sell agreements. Again, that ensures that if someone, a key partner or a key family member or a key employee passes away, we have the funds available to buy out their spouse to make sure that their family has enough money to live on without causing distress in the business. The business doesn't have to take their reserves or general cash flow to help pay this out. So we want to make sure the proper documents are in place to make sure the purchases are done appropriately, make sure that there's a policy for how the value is going to be determined, and then funds available to fund that. Disability, that would mainly be involve insurance. Disability insurance, again, for key members of management, family members. They're going to need, if they're not able to work in the business and draw an income from the business, they're still going to need cash flow. So we want to make sure we have tools in place, again, to help prevent more stress on the business than necessary. Divorce, of course, this is can get very messy, and but again, there's certain things we can do with entity structure and ownership provisions to make sure if that happens, that the right people are getting bought out, that there's money there to pay off the spouse in that divorce situation. And most importantly, that outside owners, people that don't know much about the business or you don't want involved in the business, don't get involved, don't end up with ownership that could cause disruption in your business. Disagreement, again, this would have to do with family members or partners. There's always going to be issues that come up. Sometimes it's worse than others. And the most important thing there is to have a sound operating agreement that addresses some of these disagreements. So when a partner wants to get out, he decides he's done with the business, he wants to be bought out. You need to have things in place that he can't sell to an outside party to get someone else involved who's going to take over the business. So we want to have an operating agreement that spells out how that's going to be valued and how that person is to get paid out, and gives the business some options how to do that, and not the person who's leaving. And then finally would be distress. And of course, as Mike said, everybody's been dealing with that the last 12 to 14 months. So there's certain things we can do there with insurance coverages for casualty, for fires and other disasters. There's business interruption insurance. So any of the things that will provide, again, cash flow to help supplement that cash flow when businesses are hit with a sudden interruption of cash flow, or having to shut down completely, as was the case in the past year. We need to be flexible. And we also want to be able to, as Mike touched on, be flexible with expenses. Are you in a position where you can cut expenses when you know the cash flow isn't coming in? As I mentioned earlier, the best way to make sure you have a plan in place that will stand the test of time is to make sure you're using a holistic approach when doing your planning, both on the business and personally. And this involves, it's a term used a lot in financial planning these days, but it really involves looking at your entire financial picture before making any decisions, both for the business or personally. The key here is you want to make sure that you're connecting your tax planning along with your wealth management goals. So every financial decision you make in your business and personally has some type of tax effects, either positive or negative. So you want to make sure you have a good team in place between your CPA or accountant, your attorney or financial advisor, or maybe your insurance agent. Make sure they're all on the same page and involved in these decisions to make sure that everybody's in tune and helping you the best that they can. You also want to make tax smart investing options and think about taxes when you're doing your work with your investment advisor. I've done tax returns for over 30 years, and I can't express the number of times I had a client come in after tax season, after